Welcome to Under One Roof MTL, where we are demystifying home ownership one episode at a time. Today, we're going to be taking a look at Equifax's new Consumer Credit Trends report with Jean-Philippe Saumure from Equifax Canada. That's coming up in about 15 minutes from now. But first, our trivia question of the week, brought to you by Felix and Norton Cookies. Before I actually share that trivia question, I should say hi to the gentleman in studio with me.
Seriously, what happened?
It's the Robin Flynn Show now, haven't you heard? Joined, as always, by the fantastic duo Fred and Martin from Fred and Martin Mortgages. Good afternoon, gentlemen.
Good afternoon, Robin. Happy Father's Day, guys.
Yeah.
Father's Day to all the papas listening, including LJ Aguinaga of LJ Realties. It's your first Father's Day, right, LJ?
It is.
Father's Day.
Congratulations.
Thank you. Very exciting day.
Awesome. Very exciting. Happy Father's Day to my husband, who's a great father. Happy Father's Day to my dad, who's a great father. And happy Father's Day to all the dads who are listening. Great opportunity for a father to win some cookies. What better way to celebrate Father's Day than some delicious cookies from Felix and Norton? Our question today, who is the person who oversees the sale and transfer of a property in Quebec? If you think you know the answer, 514-800 and include your first name. The first person who texts in the correct response will receive cookies from Felix and Norton. Guys, lots of stuff in the news this week, so let's just dive right in. We had our big rate cut last week, but rates are still a lot higher than they were a few years ago. In fact, 76% of mortgage holders say they're anxious about their upcoming renewals. So, guys, how much should people be expecting? I saw a thread on a mommy group that I'm in on Facebook where people were freaking out about their mortgages coming up for renewal. What are we looking at? What should people be expecting as they come up for renewal?
Well, first off, before we start talking about further reductions in rate, I think a lot of people don't need to panic, right? We got to stay calm. Second thing, if you get a mortgage renewal or are in the process of renewing your mortgage, start early. Shop around like crazy. And if you do get an offer from your lender, negotiate. Just don't accept it. And fourth thing, and obviously I'm preaching for my own parish, use the services of a mortgage broker. Because what we can do, Fred and I, is that we can shop around for you. We have access to over 25 lenders, and we can take your file from one lender to another and really find the best conditions, the best situation for you. So I would actually front it, as opposed to saying don't panic. Panic by calling us and get us to work on your file as early as possible, because there are things out there that we have access to that you don't.
That makes sense. But regardless, your payment is going up. Like if you're someone who signed one of those crazy mortgages from 2020 and you're up for renewal this year or next, you can expect an increase. This is like an inevitability at this point. And that mommy group post that I was referring to, like the people in the comments were scaring the other people saying, my mortgage increased by $800 a month. My mortgage increased by $1,000 a month. And like this obviously depends on the size of your mortgage. But the other people in the group were like, I literally can't afford an $800 increase. If that's my increase, I have to sell my home, which is like, again, this is like a fear-mongering situation and why you should never join a Facebook mommy group. But LJ, what are you seeing right now?
Remind me to never join a Facebook mommy group. But I just ran some numbers for everybody just to give you a bit of clarity on what this looks like and what we can expect. So if you have a $500,000 mortgage today and you were at a 2.8 rate, which is pretty common a couple of years ago, and you're renewing today at 5%, for example, you're looking at an increase of $640 per month. Okay, that's what you're looking at right now in kind of the change of things. So it's definitely a significant figure. The reality, and something that I like to remind everybody is the fact that at the time that we were giving these mortgages out at 2.8, sub 3, sub 2, etc., the stress test was still 5.25. So people are about to have to make a very difficult decision between their quality of life and remaining potentially house poor. Now, people who want to stay in their neighborhood because of the schools, because of the house, because it really just is a hassle to move sometimes when you're being forced to do it, not because you want to, they're going to have to basically give up some of the vacations, some of those extra nights out for dinner, movies, etc., because all these things add up, and it's really going to come down to what's your bottom line and what is more important for you to keep. Now, other people are going to opt for potentially, saying, hey, let's downsize. I don't need all of this. I can go into a rental, etc., and see what's what. But at the end of the day, if you can keep that asset in the long term, first of all, you can always refinance if rates do come down further. You can take a variable rate mortgage kind of for a temporary solution, if you will, or to get you over the next 12 to 24 months possibly. And then obviously you're still gaining the equity, you're still gaining appreciation. And as rates do start to come down, we're going to see prices start to go up. So you are going to have an investment that's going to continue to grow right now as this trend starts in this direction.
That's funny because I was going to ask you a question and you actually started answering it. Because you've got a property management company and you're also in the real estate business, there are a lot of people who are starting to call us and say, hey, you know, I think it's going to be cheaper for me to rent. Should I sell my property, rent short term, and then try to re-enter the market when rates have come down? And what's your feeling knowing that you're playing on both sides of the fence?
Rents are expensive these days. To be quite frank, any rent that we're seeing right now, I think we did some quick numbers, and in our portfolio, the average rent's about $2,100, $2,200, and we have a lot of 2-bedroom rentals in the greater downtown area, or so Verdun, Southwest, Plateau, etc. We were about to list a 3-bedroom in Beaconsfield, a bit of an older building, and that's about to go for about $1,850. We just listed a half basement in Vaudreuil for about $1,850 for a 2-bedroom with outdoor parking. So when we're looking at the differences, I mean, ownership is more expensive, 100%. But you're paying down your capital every single year. You're enjoying the appreciation of the property every single year. I mean, even during the downturn that we had in the greater Montreal area, we saw prices dip 10%, and this for less than 12 months. So to be quite frank, we're quite hedged in our market over here, and we're protected in that sense. So do I see going to a rental as a lucrative financial option? No. If you were timing, you were about to downsize anyways, you were planning on selling in the next year or so anyways, because you want less of a home, because you don't want the maintenance, the upkeep, then it could definitely probably be a good time for you to do this right now. And you want to take some time before you find the right property to buy into, whether that's a smaller condo, a bungalow, smaller house, etc. But the idea of, you know what, I'm just going to sell it and then wait and get back into it, if you're not forced to do so, I don't think that's going to be the financial winning option. Obviously, if that's your only option, then this is your only option, but I don't think that's the best financial move.
Because my other concern in all that is if you do sell your house and you rent for a couple of years, will you ever be able to get back into a house? And so what I say to my clients is what I've been saying to Fred and our clients is that if you can stay in your house, it'll always be the best long-term investment you'll ever make.
Yeah, I assume you agree with that, Fred?
Well, I listen to you guys, and I think it's time for people to really make a budget. You know, we live usually. I spoke to a lot of our clients, and they don't really know how much it really costs their city and school taxes, how much they cost, living, their mortgage payment, exactly how much it costs. They're not into that, and I think it's really time to really look at your financial a situation. Do you have a lot of debt? Do you really need a new car? Do you really have to, spend that much on certain other things? And I think it's really time to people to sit down, to make a budget. And obviously, like LG says, I'm totally agree. Like the next mortgage payment will be anywhere up by $500 to $800 for pretty much everyone out there, which is, it's really time to look at your budget. This is what I recommend to most of the client at this time. Don't be scared about your renewal. Just look at your budget, put your expense down, and let's see where we could go with that. And obviously, I'm agree with Martin. Use a good mortgage broker, because we could break down those numbers with you and help you to navigate through your mortgage renewal.
And you don't just want to work with a good mortgage broker, you also want to work with a good real estate broker. And that's why LJ is on the show, because he's the best real estate broker in Montreal. There were some interesting numbers that came out for the month of May, LJ. Do you want to take us through some of them?
Sure. So sales for the month of May rose by 4% compared to May 2023. We should keep in mind that this is in comparison to the strong market that we saw at this time last year. This was really kind of the heat of the moment in 2023, whereas the rest of 2023 was really quite quiet. Single-family homes in Montreal saw a jump of 2% compared to the same time last year. Condo sales were up 5%, with small income properties increasing 11%. That's really where we saw a huge jump. Income properties are up across the board. People are excited about investing in real estate again, which is really exciting to see. Active listings went up 22%. We have a lot more people entering the market right now, so there's a lot more properties available for sale. Prices went up overall from a year ago and remained stable compared to April. So across all property types, we saw Condos were at an average price point of $410,000, which is 2% higher. Single-family homes were at $575,000, up 5%, and plexes were at $780,000, which is an increase of 7%. So across the board, we're seeing prices increase, sales increase, and the market's been pretty stable right now. So it's an interesting market to be watching and being a part of.
Coming up after traffic, what's an interest rate differential? We're going to find out, but first we'll hand things off to the CJD 800 Traffic Center. This is your lingo lexicon on Under One Roof MTL. Interest rate differential. An interest rate differential is a financial penalty charged by a lender when a borrower breaks or renegotiates a fixed-rate mortgage before the end of its term. The interest rate differential compensates the lender for the loss of interest they would have earned had the borrower kept the mortgage for the full term. The penalty is usually calculated based on the difference between the original mortgage interest rate and the current interest rate for a similar mortgage term. For example, let's say Jason has a fixed-rate mortgage on his house in Pierrefonds with an interest rate of 4.5% and 3 years left on his term. Jason wants to break his mortgage to take advantage of a new, lower rate. The lender calculates the interest rate differential by comparing his original rate to the current rate for a similar 3-year term. If the difference is significant, Jason may face a substantial penalty for breaking his mortgage early. That's why it's always important to review your mortgage, so you're aware of the penalties if you break it. And why you should call Fred and Martin to find the best possible deal. This has been your Lingo Lexicon on Under One Roof MTL. Consumer debt rose to $2.46 trillion at the end of Q1 2024, marking a 3.5% increase from the previous year. This is according to the latest Market Pulse Consumer Credit Trends and Insights report from Equifax Canada. Here to break it all down for us is Jean-Philippe Saumure, Principal Consultant Data and Analytics at Equifax Canada. Welcome back to the show, Jean-Philippe. Wonderful to have you here again.
Thank you. Very happy to be back.
Excellent. So the report indicates that consumer debt, as I mentioned, rose in Canada to $2.46 trillion. What sort of factors are driving this increase that we're seeing?
Yeah. Well, as per usual, really two main key drivers behind this growth, and we like to segment it into mortgage versus non-mortgage. The mortgage growth, mortgage is the credit product that makes up all this $2.6 trillion. As we can imagine, it makes it roughly 77% of that total. We have seen a slight slowdown in terms of mortgage growth. As we know, interest rates have been high for now just about 2 years, even though we just last week got a slight relief on that end. But the home prices have kept getting upward. The average home price is still growing. So on the mortgage side of things, although we do see a little bit of a upward trend, the bulk of this growth really comes from non-mortgage. And really, when we look at it, it's the credit card. Credit card balances is really the main driver behind the growth. And when we talk about credit cards, really, we have to consider things like growth in population. As we know, in the last 12 months, Canada has, probably received around 1.2, just under 1.2 billion new people in Canada. So that one of the first credit product typically the newer to Canada is the credit card. So that explains that growth. But overall, what we could say is that this $2.46 trillion is showing these signs of financial strength and signs that consumers are adapting to the current financial environment.
So I'm going to ask I'm going to ask a question to Jean-Philippe, but I also like to hear the group on this. A lot of people say that a mortgage is good debt as opposed to credit cards and lines of credit being bad debt. Jean-Philippe, do you guys at Equifax, do you ever talk about good and bad debt? Do you see mortgages as being good debt vis-a-vis credit cards and lines of credit as being bad debt for a consumer?
I mean, it's a good question. I understand where the point of view somewhat it can classify good debt versus bad debt. I think in the context of buying a house being an investment, you maybe from that point of view, you could say that, yes, a mortgage can be considered good debt, while a credit card is bad debt because really there's no return on investment. So from that point of view, I would agree with this classification. At Equifax, we deal with credit. So a credit card debt in itself is not bad if you pay on time, because credit card debt will over time help any consumer build up their credit. And so that is a positive in itself. So we don't classify debts that way. We use terms like mortgage debt, non-mortgage debt, because those types of credit products and how consumers, leverage and use those products are fundamentally different. How consumers behave with their mortgage is different than how consumers behave with their credit card, their lines of credit, their auto loans. But all in all, this is not terms that we use at Equifax, because at the end of the day, good or bad, especially in the current environment, consumers need their credit card. Consumers need their cars to go to work. So in that sense, we don't.
Yeah, Jean-Philippe, a question for you. What do you think will go? Because you know that 2/3 of Canadians has to renew their mortgage in 2025 and 2026, and the interest rate will be anywhere between 4 and 5%. You think it's gonna, it's gonna be a big issue at Equifax? Because as you said, that people who are using their credit cards and car loan, now they will have probably to pay 500 to 700 more on their mortgage.
Absolutely, that's a good point. So we use the term payment shock here at Equifax for the past year and a half, 2 years, in the context of consumers renewing their mortgage, especially purchased a house 3, 4, 5 years ago, where interest rates were much lower. You will have a payment shock. So going back to your question, where things will go, where while we're starting to have a little bit of an idea, because the data that we have from the last quarter seems to indicate that consumers are more and more adapting to this new environment. And when I say new environment, payment shock on mortgage renewal is one of the most important factors to consider. And I'll just, giving you some statistics. When we say consumers are adapting to economic environment, we at Equifax, we see a much higher proportion of consumers actively looking at their credit score. 19% year-over-year when on our end, consumers looking at their own credit score. That's very good. That's positive. That is a sign that consumers are aware of that the impact of their credit score might have whether they're going into renewing their. In order.
Okay, quickly, Jean-Philippe, any tips that you could give to a listener how to keep their credit in good shape?
Absolutely. Well, it's going to sound very basic, but pay on time. The worst thing someone can do for their credit is to actually be late on their payment. Whether that's a credit card or a line of credit, your auto loan, your mortgage, obviously, but it doesn't matter the type of loan that you have, as long as you pay on time, you should. That's the bulk of it. Other kinds of tips that we can give. Credit cards, as I mentioned earlier, a credit card is a good foundation builder for credit. So if you have a credit card, especially younger people at 18, 19, 20 years old, get a credit card. Doesn't have to be big. If you limit $500,000, make sure to keep that credit card as you get older. 10, 15 years later, the history of this account and the age of this account will positively contribute to your credit score. So those are the types of things.
We're running up against the clock. LJ, did you want to get a question in before we wrap up?
Sure. So thank you so much for your time today. One question I have for you is, obviously, with everything that we're seeing right now, Are you seeing more bankruptcies, more consumer proposals? Are we seeing that really go up right now, or are people really weathering the storm and kind of keeping it together?
Good question. So as a whole, in Canada overall, we are seeing consumer proposals since COVID has really been the insolvency vehicle used by consumers. So overall, consumer proposals have been trending upward, and that's been true enough for 3 years at the very least. So yes, we are seeing Portland. We are seeing more and more consumer proposals. We are very close, if not slightly over where we were before the start of COVID. But if we look more closely at a region like the province of Quebec, we are fared a little bit better. Our insolvency rate in Quebec is still lower than where we were pre-COVID. Doesn't mean that we're not going to get back to that point eventually, but especially when we compare ourselves to a province like Ontario, we are faring a little bit better. But again, consumer proposals and insolvency overall.
Jean-Philippe Saumure, Principal Consultant Data and Analytics at Equifax. Thank you so much for your time today. Really appreciate it, Jean-Philippe.
My pleasure. Thank you.
Still to come, fixed mortgage rates are falling. Should you opt for variable or fixed right now? We'll answer that question after the news.
What are the rules surrounding a down payment and closing costs? This is your Mortgage Minute. The minimum down payment for a house or a duplex, if owner-occupied, is 5%. Down payments can come from savings, the sale of a property, a gift, or from your FHSA or RSP accounts under the Home Buyers Plan. In the case of a down payment from savings or investments, you must demonstrate that you've held these funds for at least 90 days and provide the lender with statements proving this. Closing costs, these can include but are not limited to notary fees and the welcome tax, and are calculated based on 1.5% of the home's purchase price. Let's do some easy math. On the purchase of a property of $400,000, you need to come up with at least $20,000 for the down payment and $6,000 in closing costs for a total of $26,000. Budgeting for a down payment and closing costs is crucial if you intend to purchase a property.
This is Under One Roof MTL on CJD 800. I'm Robin Flynn with Fred Pichette and Martin Spalding of Fred and Martin Mortgages, LJ Aguinaga of LJ Realties. Guys, fixed mortgage rates are falling. Great news if your mortgage is up for renewal, but should you opt for a fixed or variable rate right now? I have a sneaking suspicion that I know what all three of you are going to say. I've got my little crystal ball here, and I think we're going to go 3 for 3, choose a variable. Am I right?
No way. No.
Yeah.
It's Miss Fontaine. Exactly.
All right, so I'll start with you, Martin. Would you recommend a fixed or variable rate right now?
I would go fixed 3 years, and I'll explain why. I think the spread is still too great between fixed and variable. And if someone asked me point blank, what would you do? I would go 3-year fix currently.
Wow. Fred, what would you suggest?
Well, I'm a big fan of variable rate, and I think if your mortgage is less than $200,000, I think you could take a little guess that a variable could be a good option. But again, I have to agree with Martin, like the spread between the variable and fixed, it's huge, which is, I would intend to stay fixed for 3 or 5 years if you want a peace of mind. But well, as people know, I'm a big fan of variable for one reason. If anything's happened in your life, the penalty on variable rate, it's only 3 months of interest. And when I say only 3 months of interest, it's very important because I know a lot of my clients that pay a big penalty on their fixed rate, and they're not really happy about it, and they remember it, which is these things will not happen with a variable rate. But obviously, you will pay more at the moment, but it could be a good option. But I'll stick with the team with Martin on this one at the moment.
Ooh,
At the
super
moment.
wrong today. Super wrong. LJ, what would you suggest?
So my answer is it depends. So neither 200 years. It really depends on what your situation is. Is it an investment property? Is it your principal residence? What is your time horizon? Do you need the flexibility of potentially selling? Are you alone? You're going to have this property. Even if you choose to move out, you're going to potentially turn it into a rental, and therefore you can take that longer term. I was just renewing one of my investment properties, and I given the spread, it's going to be the 3 or the 5 year fixed right now. But I'm looking at a mortgage right now with somebody else, and they're like, hey, I'm not sure if I'm going to keep the property for a very long time, maybe a year, maybe 2, maybe 5. And I'm like, in that case, you're best off with the variable because you need flexibility, right? So it really is a case by case. It really does depend on each and every person. And Fred, I'm not sure how many mortgages you know that are under 200,000. At least I don't know too many people who are sitting with a less than $200,000 mortgage. Even my sister, who has kind of a starter condo right now, the mortgage I think is just over 200,000. So
No, it's not really about how much is it. It's how your risk tolerance is all about. Like obviously, if your risk tolerance is a bit higher and your mortgage is at $400,000, it'll cost you more at the beginning because the spread, the discount on the prime rate, it's low at the moment. But I'm pretty sure over 5 years we could potentially see variable rate going under the fixed rate. Now, is this gonna happen in the first year? No, but again, that thing could happen. But agree with LG, with $200,000, it's a little bit low for the greater Montreal market.
Martin?
So a couple shows ago, LJ taught us a great expression, and I think it's really pertinent in this discussion. Rates take the elevator up and take the stairs down. And so I don't know if you guys noticed this week, but the Fed hold firm. And generally when the United States get the sniffles, Canada catches a cold, right? So yes, we did get a rate reduction in June. There's another one scheduled. Technically, there's another announcement scheduled in July 24th. Are we going to see another rate reduction? Because rate reductions have a direct correlation to variable, and we know fixed is managed by or is influenced by the bond market. So I want to hear Fred say it again. How many basis points between now and December?
100 basis point, guys. I'm confident, I just want to remember you guys, you were telling me that it's not going to happen in June and potentially only 50 basis point by the end of the year. And
I'm sorry, were you also saying that it was going to happen in March and April and May?
No. Well, not really. When the last time we spoke about it, we thought it was clearly like June will be the first rate cut, and I clearly say that potentially by the end of the year, 100 basis point. Again, it could be 75, but I think we're on the right path right now. Like,
okay, so Fred, if it's 100 basis points, are you still 3-year fixed, or are you now variable?
Well, Martin, I agree with you that the spread is huge at the moment, and for a lot of people in consumer, you better go off with the fixed rate. But again, if you like to, bet against not against the market, but if you want to edge that market, I think I would go for variable. And it's exactly what LG says. It gives you a lot of flexibility. If you're willing to pay more at the moment, and God knows what's going to happen in 2 or 3 years from now. People says the interest rate will never go back to 2%, which is true. But again, we don't know. Nobody has a crystal ball, which is, I think at the moment, both bets are good. It really depends your situation and your risk tolerance.
So 2 things I want to add on that are, first of all, when I said it depends, it really does depend whether it's your principal residence or an investment property, because I'll typically be more inclined to take a bit more risk on the interest variability on an investment property because I'm writing off the interest paid every year, right? It's a deduction to the income generated thereby. And thus, when you have that offset, even if it is a little bit more, paying the price or the premium for that flexibility is almost baked into what you're paying, as far as I'm concerned. When it's your principal residence and you don't get that deduction, then you're a little bit more cautious with how you're going to approach it. And obviously, it is a bit of a bigger gamble in the sense that it's not just going to affect your cash flow now, it's going to affect the way your family's going to be living, right? So that's something to consider as well. And now I want to bring the conversation back to the question you asked a little bit earlier, Martin, about good debt versus bad debt. And this is a subject that I love to talk about because a lot of people... I even have a license plate printed called bad debt for eventually I'm going to have a sports car that I'm going to throw this on because I believe in the differential of good and bad debt, right? So anything tied to an asset is considered good debt. And the reason being is the fact that this is going to be something that is going to appreciate over time. It can generate cash flow for you. And if you do have somebody else paying it off for you, like a tenant, for example, we're going to have the capital pay down happening. So you have these three components of the investment working in your favor. And that's really where you're going to make your gains and your investment returns. Now, when we're looking at bad debt and why we usually say that credit card debt or all this other stuff can be considered bad debt is because it's not tied to an asset. That Gucci purse that you just bought isn't an asset, even though you might think it is. And we have to maybe separate ourselves from some of the girl math or even just general luxury brands that we're looking at here from this is an asset. I mean, there's very few luxury brands that you can actually consider an asset that are actually increasing in value year over year. I believe just the Hermes purse is one of the few things, Chanel bags. There's a couple of these that are actually appreciating, but beyond that, it's really, you got to be very, very careful. So that is, as far as I'm concerned, the good versus the bad, and keeping that in mind and making sure that you're buying or spending more or accumulating more good debt in order to set up your retirement and your future investments.
Oh, still to come, guys. We've got our property of the week. So much to get to in so little time. That's coming up after we check traffic at the CJD 800 Traffic Center. This is Under One Roof MTL on CJD 800. I'm Robin, that's LJ, that's Fred, that's Martin. We're with you until 1 p.m. We still have to get to the answer to our trivia question of the week, but first, it's time for our favorite part of the show, the property of the week. LJ, what do you got for us this week?
This week, I'm highlighting 7140 Boulevard Cousineau, Apartment 7 in St. Hubert. The stunning two-bedroom unit located on the third floor has spacious rooms, gets fantastic natural light, has a mezzanine and a private balcony. The open layout is versatile and can be arranged to suit any buyer's needs. The unit has 2 assigned outdoor parking spots, and there's a visitor parking lot as well. It is a fantastic location within proximity to schools, parks, essential services, and easy access to the highway. The asking price is $380,000. Like in most suburbs, this unit is located close to a strip mall with tons of options for food. My go-to when I first started my career was Thai Express. It was quick and super filling.
Well, LJ, it seems to be a great property for first-time home buyer.
Honestly, it's super spacious. The mezzanine with a big patio in the back is pretty awesome. Most people are complaining about parking spots. We've got 2 dedicated to this unit, obviously. So anyone looking to a small family, young couple, etc., who wants a bit of space, this is a great unit for you.
Yeah, just under 400. It's great.
LJ, what was your go-to Thai Express order?
So I would always get a pad Thai chicken and beef combo. So I'd add a bit of extra protein to it. With the combo, I'd have the little spring roll while I was waiting for the actual pad Thai, and I get a water with it.
Nice choice. I'm a chicken pad Sioux girl myself with extra broccoli.
But we should we should ask Fred about Thai food, because I don't know if a lot of I don't know if the listeners know, but Fred used to run the Thai grill.
Yeah, well,
Embarrassed to say Thai Express because of that.
well, exactly. Well, actually, Thai food is one of my favorite food with Italian and Mexican. But again, Thai Express, I think it went a little bit of refinement in the taste, but it's actually, I think it's better than a good burger or or a hot dogs. I think Thai food, it's very tasty, which is, if you were pleased with that pad Thai and pad Siu, I think it's great. But my favorite dish is always be a very nice, good Thai curry. You know, like a green curry, chicken or shrimp for me was one of my favorite.
And if you really want to discover Thai food at a Thai restaurant, take Fred with you.
Yeah,
That's exactly what to order off the menu, right?
Exactly.
He's the guy to go with.
Yeah, I could guide you. I've been in the business, restaurant business 20 years before to be a broker, and I could really help you guys with Thai food, that's for sure.
I feel like Fred just knows a little bit about everything. I would trust him I would go to him for advice on any subject. I would just trust Fred and what Fred has to say.
Well, during the break, we were saying that Fred is a man of the people, and there's more proof to it.
I like to be transparent and very cool and helpful with people because I think it's in my nature. But thank you, guys.
What we love about you, Fred. Guys, trivia question of the week. I know everybody has been on the edge of their seats waiting for the answer. It's brought to you by Felix and Norton Cookies. By the way, you can check out their store at the Blue Haven Shopping Center, 3705 St. John's Boulevard in DDO. Our question this week, who is the person who oversees the sale and transfer of a property in Quebec? The answer, of course, is a notary. So thank you very much for participating. The answer is notary this week. Guys, notary is a very Quebec thing, if I'm not mistaken. Like, it's really the only province or place in the world that does everything through notary. No?
Nope.
Okay.
Correct. Any country or any state that follows the civil code uses notaries. So Peru, for example, also uses notaries to pass transactions, believe it or not.
Interesting.
Fred, how would you know that, LJ?
I may have had to use notary services in Peru a couple times.
Most other places, it's just a straight up lawyer, right? They have a specific type of lawyer who deals with these kinds of transactions.
So in the rest of Canada, they follow common law, and because of that, they just use a lawyer to do this kind of transaction. Quebec, because we have the civil code, essentially, we have the differential after law school. You can go write the bar exam, or you can go to notarial school and get your notary's license. And at that point, you can practice and get people married and sell properties and do wills and all sorts of great stuff. So make sure you have yourself a great notary. If you need a recommendation, feel free to reach out to me. I'd be happy to share mine.
Absolutely. That's great. How do people get in touch with you, LJ, if they want to get a recommendation for a notary or if they are looking to sell their property?
So you can call or text me, 514-500-4040. Also, if you're wondering how much your property is worth, want a free evaluation, feel free to let us know. It'd be our pleasure. There's no commitment whatsoever. If you're just curious about what the value might be, we'd be happy to help you with that. You can also find me on our website, obviously, ljrealties.com, Instagram, YouTube, TikTok, Facebook, X, formerly Twitter. My handle is LJ Aguinaga. For more information on all of our listings or real estate team under the handle LJ Realties, we are looking for new motivated brokers. So if you're in the industry, you're looking for a change and you want some more support or accountability, I can offer that for you. And finally, if you need any property management services, feel free to reach out. We've been growing our portfolio. We've put a lot of systems and procedures in place to provide the best service possible. So feel free to reach out to Thierry 514-709-6397.
Awesome. Fred, Martin, where can people go to get in touch with you guys?
I'm going to add a little something to ours this week. So if you would like us to pre-qualify you for a mortgage, so if you're in the market and you want to know exactly what you can afford and what your monthly payments are going to be, call us or simply look us up on fredmartin.com. Fredmartin.com, all our information is there. My number, Fred's number, give us a call. We'll pre-qualify you.
Amazing. If you missed anything, you can listen to the show in its entirety on iHeartRadio, Spotify, Apple, wherever you get your podcasts. You can also check out our website, underoneroofmtl.com, see all four of our beautiful faces. Want to make sure we do give an extra special shout out to all the fathers celebrating today. Happy Father's Day to you. For LJ, Fred, and Martin, I'm Robin Flynn. This has been Under One Roof MTL.